Rental properties, completely different loan program, completely different animal in terms of how we qualify borrowers in this space. We do not require personal income on these programs either. No tax returns, no property count max. We can lend 80% of purchase price. We can lend 75% of appraised value on cash out refis as long as the investor has owned the property more than 3 months. So there's only a 3-month waiting period or seasoning period for us to lend on appraised value instead of cost, which is a huge competitive advantage that a lot of our investors take advantage of. One other thing I'm going to talk to about this is all qualifying is all based on cash flow. And I just want to spend some time on this because you need to understand that not every property, these loan programs are extremely property specific in terms of what interest rate we charge and what loan amount they qualify for. You might have a $400,000 house in Tampa, Florida that can sustain a much larger loan size than a $400,000 house in Jacksonville, Florida. It all depends on the factors of what is the monthly rent that property is earning right now. Think of that as the income. That's how we hang our hat on the property's ability to generate a rent payment every month to pay us back. So what is the gross rent? How much is it? How much are the taxes annually? How much is the insurance annually? Is there an HOA? All three of those expenses eat into cash flow. Okay, so that's why every property is different, and it needs to be run through our system, which you all have the ability on foacommercial.com to price out these loans. So if you call me and say, yeah, I have a realtor that's that has a buyer that's going to buy an investment property and it's all rent ready, it's ready to go, then how much can we lend? Well, I don't know. It depends on the property. You have to put in the property's address. You have to put in the gross rent, you have to put in the taxes and the insurance and the HOAs, and my model will run that cash flow analysis and tell you what interest rate they qualify for and what loan size they qualify for. All right, that's how that works. So if a realtor says, can you give my investor wants to buy an investment property, but he needs a pre-approval letter first so that we could go out and look for property. We do not offer a pre-approval letter because we're not qualifying the borrower. We're qualifying the property. So you have to bring me a property that I can qualify for in order to give you a pre-approval letter. So it's a different mentality, a different way of looking at how we qualify borrowers. We don't qualify borrowers, we qualify the properties. All right, enough of that. Two programs, single rental loan and portfolio rental loan. Single rental loan is what you're going to be doing the most of. These are investors that want to do a cash out refi of an existing property or a purchase transaction. Look at our minimums and our maximums. We package all these up to resell to investors, and currently they want to stay in this bucket of a minimum loan size of $75,000, maximum loan size is $750,000. So you can look at $1 million purchase transaction and make a loan for $750,000 if it qualifies for, if the cash flow can support the maximum loan size, that's what we'll do. Of course, there's no line of credit here. This is one loan, one property on the single rental loan. It's a 30-year fixed full AM. So there is a principal and interest payment. We'll do 80% on purchase, 75% on a refi. Property debt to income ratio. This is the math that we run. No more than 85%, which is principal, interest, taxes, and insurance divided by gross rent. That's how you get PDTI. You don't run this. My model does. This is just telling you how my model works. If the property value is over 150, we'll allow a tighter cash flow all the way up to 85%. Principal, interest, taxes, and insurance. But if the property is less than 150, the max PDTI is 70%. Don't get hung up on that. You'll just understand that when you run the model to see how the property cash flows. We'll make loans to LLCs or individuals. Look at the property types. We're not lending more than a fourplex. So we're not doing multifamilies on the single rental loan. But if you switch over to the right column, and you're doing a portfolio blanket loan, we will go up to 20-unit apartment complexes on the blanket loan. Prepay on the single, yes. We do not want to get, our investors do not like to get paid off in the first 3 years, of course. So there's a declining 3-year, which means If they pay off in the first year, it's a 3% penalty. They pay off in the second year, it's a 2%. They pay off in the third year, it's a 1%. After 3 years, no penalty. Minimum credit score, 660. All of my credit scores are firm, hard, and they're hard stops. If your borrower tells you that they have a 700 credit score and you enter this into our system, you run credit on my system. If it comes in at 659, the deal is dead. I'm sorry, we can't sell those loans if they're less than 660. We take the middle score. If you have multiple borrowers, let's say you have a 4-member LLC, we're going to run credit on all 4 of them, and we're going to use the highest mid score. So that's very flexible. We don't average them. Whoever's got the highest mid score, that's what we use for pricing. A 660 score gets a little higher interest rate than a 720 credit score, and everything in the middle. Portfolio loans, all you need to know is the minimums. We will not write a portfolio loan with a loan size less than $700,000. So you need several properties, you need at least 7 doors, and as long as you have at least 7 doors and a minimum loan size is 700, which would be, total property values over $1 million, then we can look at doing that. The term is not a 30-year fixed, it's a 30-year AM, but it's a 5-year balloon or a 10-year balloon. Debt service coverage ratio is a different method of looking at cash flow. And again, we will go up to the multifamilies up to 20 units on that. And there is either prepay, there is yield maintenance, which means if they pay off the loan earlier than the set 5 or 10-year term, they're still obligated to pay the rest of the interest. And also they can choose it declining. So they can choose a declining 5, 4, 3, 2, 1. These loans are not for investors that just might decide to pay off the loan after a year. These investors, typically seasoned investors, they have a time frame in place. They know that if they take this loan, they're gonna hold these properties for at least 5 years or 10 years, and that's their strategy. They may have an exit strategy of, after 5 years, I'm gonna sell the portfolio and take my profits and leave. Or I'm willing to go 5 years and then requalify and renew at current interest rates, which could be higher. All right. For those of you that like to do the math,